or have another print disability which makes reading, holding a book, or turning a page difficult or impossible. The content is copyrighted by the respective publishers. For more information, please visit us on the web at nfradioreading.org.
Hello, this is Dasha, and for the next hour, I'll be reading from the Friday, August 7th issue of the Wall Street Journal on the Niagara Frontier Radio Reading Service. There are a number of articles in this paper which are way too long to read on the radio, so remember, if I have to stop early, you can call 716-821-5555, and staff will be happy to read you the rest of the article. On the front page, Refiners Go Full Tilt Amid Fuel Crunch by Benoit Morin and Colin Eaton. President Trump wanted to have U.S. energy dominance and low energy prices. He's getting one without the other, and he hates it. The Iran war and Ukrainian strikes on Russian refineries knocked out a big chunk of the world's fuel-making apparatus, leaving the U.S. oil industry as the world's last major fuel supplier and a global supply shock that could last well into next year. U.S. refiners are running plants at full tilt to meet demand at home and abroad as fuel prices soar, giving them windfall profits and drawing the ire of President Trump, who ripped into oil companies this week for wringing too much cash out of the American gas pumps. While U.S. gasoline exports have held relatively steady, diesel exports hit a record 1.9 million barrels a day last week, and jet fuel shipments were near record levels, according to data from the Energy Information Administration. The White House is watching inflation and affordability issues heading into the November midterm elections, and high diesel prices can boost the price of everything from groceries to lumber. But Trump's energy frustrations aren't likely to be solved this year. Bringing prices at the pump down will require global energy flows to recover to their pre-war levels, according to the chief executives of ExxonMobil, Marathon Petroleum, and Valero. That means rebuilding refineries across the Middle East, from Saudi Arabia to Kuwait to Bahrain, that Iran targeted. Energy analysts said they expect markets to remain tight through the end of 2027. Ukrainian drones continue to rain down on Russian energy assets, too. Russia, once a top exporter of fuel, had about a third of its refining capacity knocked offline and banned some fuel shipments until January. Meanwhile, fuel exports from China collapsed, in part because it's getting less crude to process from the Middle East. The Iran conflict has stymied traffic in the Strait of Hormuz, a vital artery for oil voyages from Gulf countries. Saudi Arabia's oil exports to the U.S. dropped to zero in July, the first time monthly federal data show that happening since 1985. U.S. refiners have opted to buy more crude oil to process from American oil fields, such as from Canada and Venezuela. Trump said in a Fox News interview on Tuesday that U.S. negotiators were close to a deal with Iran that could open the strait, and he believed the move would trigger the average price of a gallon of gasoline in the U.S. to fall to $2.50. As of Thursday, the U.S. gas price averaged $4.06 a gallon. The persistent problem, executives say, is refining. I've never seen the available capacity relative to demand as low as it is today, said Darren Woods, CEO of Exxon, the nation's third largest oil refiner. It's going to take a while for the industry to kind of climb its way out of that hole. Roughly 5 million barrels a day of the world's refining capacity is out of commission between the Middle East and Russia, energy executives said. At the same time, the world is projected to consume roughly 65 million barrels a day of gasoline, diesel, and jet fuel this year, according to the International Energy Agency. White House spokeswoman Taylor Rogers said U.S. refining capacity is critical to keeping energy prices low for families and businesses, and blamed Democratic climate policies for shuttered refineries across the company. President Trump has reversed those destructive policies to ensure the United States and the world has access to reliable, affordable, and secure energy, she said. More than 24 refineries shut down in the U.S. since 2000. Several big refineries have become more massive in recent years as energy companies built additional units at plants to allow them to make more fuel. The nation's collective fuel-making capacity is 3% lower than it was at its peak in 2019, according to federal data. The Trump administration in March unveiled a refinery project in South Texas, backed by India's Reliance Industries. If it comes to fruition, the complex would be the first new refinery built in the U.S. since 1977. There is a bit more of this, so if you want to hear it, please call 716-821-5555, and it will be read to you. A melanoma drug gets approval from the FDA by Xavier Martinez. Replimune Group said Thursday that the Food and Drug Administration has approved its therapy for advanced skin cancer, ending a regulatory saga that spanned 3 submissions and 2 rejections and was a flashpoint in the tenure of the agency's last commissioner. Replimune's drug, marketed as Tudrakev, is a genetically modified virus that doctors inject directly into tumors, where it is designed to kill cancer cells and trigger an immune response against tumors elsewhere in the body. The melanoma drug's arduous journey through the FDA made it a poster child for the biotech industry's criticism of the agency under former Commissioner Marty Makary. Replimune and other industry officials said the FDA, in its rejections, had reversed positions it had established in earlier meetings with the company. Replimune first submitted its application for the therapy in November 2024. The FDA rejected it in July of last year and rejected a resubmission in April. Regulators said they couldn't tell how much of the drug's effect came from Tudrakev itself, rather than the medication it was tested with in combination therapy. The study didn't have a placebo arm either. While still head of the agency, Makary publicly defended the rejections of Replimune's medication. "If your drug works, it's going to get approved," he said in May. Ultimately, the White House pushed public health officials to re-examine the FDA's repeated rejections of the Replimune drug, the Wall Street Journal reported. After Makary left the agency, Replimune said it had reached an agreement with the FDA to try a 3rd time. The FCC has repealed a cap on TV station ownership by Joe Flint. The Federal Communications Commission voted to repeal the national cap on television station ownership Thursday, potentially clearing the way for further consolidation of broadcasters. In a 2-to-1 split, the agency voted to eliminate a rule that prohibits any company from owning television stations reaching more than 39% of U.S. TV households. The FCC said it would instead review proposed station acquisitions on a case-by-case basis. The FCC said the cap had become outdated and hindered broadcasters' ability to compete for viewers and advertising dollars against streaming services, podcasts, and other digital platforms that face no comparable restrictions. The FCC's move is part of a broader effort by the Trump administration and its allies to eliminate regulations that they view as antiquated or excessively limiting for businesses. FCC Chairman Brendan Carr, a Republican who has long advocated eliminating the cap, said removing it would help level the playing field for broadcasters. Repealing the national cap will provide essential relief for local broadcasters by restoring a healthy counterbalance to the growing leverage of national programmers, Carr said at the meeting. Carr also said allowing local broadcasters to increase their holdings will give them more leverage with networks such as ABC, CBS, and NBC. The order could face legal and political challenges over whether the FCC, not Congress, has the authority to repeal the rule. Congress set this cap in federal law, and only Congress can change it, said Democratic FCC Commissioner Ana Gomez, who cast the lone dissenting vote. Gomez also criticized removing the cap itself, saying it would hurt local news as consolidation would lead to more cost-cutting by a handful of big broadcasters. Senate Commerce Committee Chairman Ted Cruz, Republican of Texas, during a hearing earlier this year, also questioned whether the FCC has authority to modify the ownership limit. The FCC said in its order that the cap was a commission rule rather than a statutory requirement and therefore can be lifted under the Communications Act. Congress established the 39% limit in 2004, intervening after the FCC moved to raise the cap to 45%. The FCC earlier this year granted Nexstar Media Group a waiver to complete its acquisition of Tegna, a deal that exceeds the ownership cap. Although that transaction has closed, it is being challenged in court by 8 states seeking to block the merger on antitrust grounds. Companies at or near the 39% ownership limit include Nexstar, Fox, CBS parent Paramount, and EW Scripps. Industry analysts have identified Sinclair and Gray Media as potential acquirers if larger station transactions become less restricted. Fox and Wall Street Journal parent company News Corp share common ownership. Another front page story, which is too long to read all of, is some investors' SpaceX shares vanished before they cashed in. About 1,000 special-purpose vehicles are tied to the stock. That could pose risks for some expecting windfalls. By Corey Drybush. Ram Rupareddy could hardly believe his luck in 2020 when his friend told him about a New Jersey firm pitching investment opportunities in SpaceX and other buzzy privately held companies. Rupareddy lives in Ashburn, Virginia, with his wife and 2 kids and was earning a reliable income as a data engineer at a healthcare company. But he had friends in the Bay Area who had invested early in hot startups, and he wanted in. This was his chance. The investment firm, Late Stage Management, wasn't selling actual shares, but stakes in vehicles that it said held them. Known as special purpose vehicles, the funds hold shares in private companies either directly or indirectly by investing themselves in other funds with stakes. The SPVs provide a workaround to the limit on the number of shareholders private companies can have without offering more detailed financials. They operate under few regulations and are supposed to be only for accredited investors or those whose net worth or income reaches a certain threshold. Rupareddy's friend introduced him to a sales manager at Late Stage, Jeremy Barish. They spoke on the phone, but mostly messaged back and forth on WhatsApp, and he said he never met with anyone from the firm in person. In November 2020, Rupareddy messaged Barish about how he had missed out on a few big IPOs recently and how he'd love to participate in buying stakes in Impossible Foods, SoFi, and SpaceX. Barish said all 3 were available and sent over paperwork for Rupareddy to sign. Rupareddy wired over money before the end of the year, including $17,250 to take part in a fund that held shares in Elon Musk's SpaceX, according to documents reviewed by the Wall Street Journal. At the time, he estimated the rocket maker was valued at $58 billion. When SpaceX went public this June at $1.77 trillion valuation, Rupareddy's dream of a windfall seemed within reach. It's turned into more of a nightmare. Shortly after the IPO, Rupareddy and 3 other investors who spoke to the Journal said they couldn't log in to Late Stage's web portal for investors. Rupareddy said the investment firm eventually told him in an email that it sold the SpaceX shares he was exposed to in 2024, when they were worth around $105 each, and before a 5-to-1 stock split, or when Rupareddy's holding was worth $45,450. But Rupareddy, based on the holdings shown on his investment portal as of May 2026 and on his 2025 tax document, believed he still held the equivalent of 2,500 shares of SpaceX, which at the IPO price he estimated were worth more than $300,000. The plan was to fund college education for both of my kids. One's a rising senior in high school, said Rupareddy, who has since filed a complaint with the Securities and Exchange Commission. Other investors in the fund were also alarmed. Rupareddy says he believes more than 100 others are in a similar situation based on a group chat that has formed with about 150 late-stage investors. Some have hired lawyers to file a complaint against Late Stage with the purpose of recovering and preserving their IPO shares of SpaceX. One investor in the fund told the Journal an SEC lawyer called him in July to question him about his experience with late stage, and he said an FBI special agent was also on the line. A test began on Thursday when a first wave of pre-IPO SpaceX investors were permitted to sell shares under so-called lockup agreements. Bankers estimate there are at least 1,000 SPVs tied to SpaceX stock alone, and it's a chance for scores of investors to cash in on the share's growth. Or they could be hit by the same panic that overwhelmed Rupert Reddy if their share of the profits fails to materialize. There is a great deal more to this article, and if you want to hear it, please call 716-821-5555, and staff will be happy to read it to you. You're listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier Radio Reading Service. Taking a look at the opinion pages under Review and Outlook, Trump fixes a Biden Medicare trick. As Democratic officials start to feel a nagging worry about far-left candidates winning their party primaries, they're again accusing Republicans of pushing Granny off a cliff. President Trump is cutting important Medicare funding, raising prescription drug costs for millions of Americans, retiring Michigan Senator Gary Peters wrote Wednesday amid Abdul al-Sayed's primary victory. Not true. Remember how Democrats used supposed savings from nationalizing student loans to pay for Obamacare? Mr. Peters was alluding to a similar fiscal trick, which is resulting in more than $500 billion in higher Medicare costs for seniors and taxpayers. The Trump administration revealed this month it plans to end a subsidy for Medicare Part D insurers. The Biden team established the subsidy to stop plan premiums from rising before the 2024 election as a result of the Inflation Reduction Act. Here's what is really going on. The IRA, which Democrats passed on a partisan vote in 2022, let Medicare officials engage in putative negotiations with drug makers. These were de facto price controls, since the penalty for rejecting the government's offer was a 1,900% excise tax on the drug's daily sales. The law also required drug makers to pay the government rebates on medicines prescribed to seniors if their prices increase faster than inflation. Democrats claimed the savings from these two provisions would pay for enhancements in Medicare Part D, including elimination of the coverage donut hole and a $2,100 annual cap on out-of-pocket costs. These benefit enhancements have turned out to be much more expensive than Democrats and the Congressional Budget Office claimed. CBO in February quietly raised the baseline cost of the Part D program by roughly $700 billion through 2035, citing the Part D design as a leading driver. That's a nearly 50% increase. The Biden team panicked in the summer of 2024 when insurer bids for providing basic Part D benefits for the following year came in higher than expected, spiking to $179.45 a month on average from $64.28 in 2024 and $34.71 in 2023. Biden officials then established a demonstration project to subsidize insurers to keep down premiums to avoid an October Part D surprise. Federal law allows the Centers for Medicare and Medicaid Services to set up such demonstrations to test new payment methods, although they're supposed to be small scale and seek to save money. The Biden subsidy wasn't an experiment, and it cost $6 billion that year. The Trump team last year reduced the subsidy and last week announced it will end it, after discovering a couple of large insurers had gamed program rules by increasing plan bids to squeeze bigger federal payments. The subsidies were distorting prices and competition in the Part D market. Most seniors won't see a premium increase next year as a result of the subsidies termination. Half are enrolled in Advantage plans, which aren't affected. Another 22% are low-income beneficiaries who receive special subsidies that will obviate any premium increase. Only 10% are enrolled in plans in which premiums are expected to rise by more than $10 a month. They can shop around for lower-cost plans or switch to Advantage plans. 90% of beneficiaries currently have access to plans that cost less than $10 a month. Meanwhile, in related news, CBO last week issued a mea culpa for the ages, noting that it grossly underestimated the IRA's cost. In September 2022, CBO projected the Medicare provisions would reduce the deficit by $129 billion between 2022 and 2031 because the price controls and rebates would supposedly more than offset the cost of benefit enhancement. Yet the price controls and inflation rebates have yielded scant savings, and the benefit enhancements have cost many multiples more than projected. In 2022, CBO projected that rebates for Part B drugs administered in physician offices would total $2.3 billion for 2023 and 2024. The rebates generated a mere $136 million, in part because inflation has outpaced many drug prices. Meantime, the IRA's Part D enhancement is turning out to be one of the most expensive entitlement expansions in history. One reason is the patient out-of-pocket cap encouraged higher utilization of medicines like GLP-1s and may also have discouraged use of lower-cost biosimilars and generics. The number of Part D plan offerings has also fallen by more than half since 2022, which has resulted in less competition and indirectly to higher prices. Because the IRA required Part D plans to cover all drugs subject to price controls, manufacturers no longer need to pay the insurers rebates to guarantee formulary coverage. These rebates help keep down premiums, which are subsidized by the government. A decline in rebates increases the normal program subsidies that government pays insurers. Entitlements almost always cost more than projected, and CBO estimates are typically Democratic enablers. The Trump administration's changes are good for taxpayers, and the shame is that the GOP Congress hasn't done more to expose and reform these Democratic tricks. The crypto lobby objects, the other part of Review and Outlook. Our dissection of the Senate's Clarity Act this week struck a nerve on K Street, judging by the furious response. The crypto lobby ducks many of the issues we addressed, but will still do them the courtesy of responding to their slippery claims. A major sticking point in the debate over the Clarity Act is the regulations regarding payments to stablecoin users. Stablecoins are cryptocurrencies designed to keep a fixed dollar peg. Last year's Genius Act required stablecoin issuers like Circle to back their tokens with relatively liquid and safe assets like treasury bills and bank deposits. The crypto folks say this eliminated stablecoin risks. Ergo, they say, imposing additional guardrails would stifle free market competition. Not so fast. Stablecoins present other risks, not least because they are entwined with the banks. The Genius Act prohibited stablecoins issuers from paying interest on user balances. Congress wanted to prevent stablecoin issuers from using higher interest payments to draw deposits from small banks, which could reduce the latter's capacity to make loans to small businesses and render some insolvent. But the Genius Act didn't forbid crypto exchanges and wallets, quasi-bank accounts, from paying returns to stablecoin holders. The Senate's Clarity Act purports to close this loophole. It supposedly does so by prohibiting exchanges and wallets from paying, quote, any form of interest or yield, end quote, that is, quote, solely in connection with the holding of the payment stablecoins or on a balance in a manner that is economically or functionally equivalent to the payment of interest or yield on an interest-bearing bank deposit. Our emphasis on solely. This language would let crypto exchanges offer stablecoin holders cashback, rebates, and other perks, as long as they're not exclusively based on a user's stablecoin holdings. An exchange could, say, offer 5% cashback to stablecoin holders who sign up for a loyalty program and keep a monthly balance of at least $1. The crypto industry calls these rewards and says they're no different than airlines, travel miles, or credit card cashback. But the latter are based on a user's level of activity. Under the Clarity Act, as we and others read it, stablecoin holders could be compensated with sundry perks, including zero-interest loans, as long as their deposits aren't the only reason they're being rewarded. Small banks stand to lose the most from this regulatory arbitrage because they rely on interest payments to attract deposits. Wall Street giants don't have to pay as much in interest because they benefit from the government's too-big-to-fail imprimatur. Many stablecoin issuers also hold deposits at large banks, so the giants may even benefit from growth in stablecoin holdings as a result of such reward payments. That's one reason it's a misdirection to claim that Wall Street is opposing the bill to avoid competition and protect its regulatory moats, to cite Coinbase executives. The reality is that crypto is more entangled with the traditional banking system than it cares to admit. Problems in crypto can ripple into the banking system and vice versa. Circle held $3.3 billion in uninsured deposits at Silicon Valley Bank before the bank failed. That caused a run on Circle coins, which caused it to break its dollar peg and fall to about 87 cents. The Biden team ultimately guaranteed all uninsured deposits, including for Circle and other crypto companies that held funds at Silicon Valley Bank. The Genius Act mitigated some credit and liquidity risk from stablecoins, and the Clarity Act provides a regulatory framework for crypto, but neither eliminates broad crypto risk. This includes fraud, failed internal controls, and cyber attacks. Sam Bankman-Fried's FTX exchange failed because of ineffective internal controls and misuse of customer funds, some of which financed risky investments. Under the Clarity Act, an exchange could offer what is effectively a 10% yield on stablecoin deposits that it may not be able to financially sustain. If something goes wrong and investors get burned, politicians will demand government come to the rescue. We've seen this many times before, and it stretches credulity to believe politicians will let crypto firms fail if they threaten bank failures. Ohio Senator Bernie Moreno charged we had, quote, descended into a Wall Street special interest group super PAC, end quote. Bernie always goes ad hominem when he can't argue the merits, which is rich since the crypto industry super PAC spent $40 million supporting his election in 2024. After his victory, the super PAC boasted, quote, crypto's big bet pays off, end quote. The Clarity Act can serve a useful purpose with some language changes. The crypto industry and its friends in Washington portray themselves as defenders of free markets. What they really want to be is quasi-banks without abiding by the same regulations. A short piece in World News. Businesses face critical situation. German forklift truck maker Jungheinrich is losing customers to Chinese competitors in Europe. The company's chief executive, Lars Brojka, estimates Chinese manufacturers have increased their share of the regional market for industrial trucks to 30% of units today from 11% in 2019. The Chinese producers started by targeting the, quote, good enough market. Machines built for moderate daily use, offered at half the price of Western peers. Now, the Chinese manufacturers are establishing local research and development centers and production facilities that should allow them to produce higher value products, Brojka said. In response, Jungheinrich last year unveiled a strategic partnership with Chinese forklift maker EP Equipment. It's a very challenging and even critical situation that we are facing, he said. Jungheinrich recently lowered its earnings forecast for this year, partly reflecting increased competition from China. You are listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier Radio Reading Service. Turning now to the business and finance section. Investor puts squeeze on Voya to seek sale by Lauren Thomas and Mark Maurer. Hedge fund Tom's Capital Investment Management is ratcheting up the pressure on asset manager Voya Financial by bringing its push for the firm to explore a sale directly to shareholders, according to a letter seen by the Wall Street Journal. TCIM holds a roughly 4.5% stake in Voya, making it one of the company's largest shareholders, according to the open letter the firm sent to shareholders Thursday. Voya has a market value of around $9 billion. Its shares have climbed more than 30% over the past 12 months, with the rally driven in part by takeover speculation. TCIM has been privately pushing Voya for months to evaluate strategic alternatives, including an outright sale of the business, to no avail, the letter said. In June, TCIM publicized a letter disclosing it held a sizable position in Voya and calling on the company to move ahead with a formal strategic review at a time of rapid consolidation in the asset management industry. TCIM now plans to call for a vote of no confidence in Voya's current management team and board, according to the letter. Voya's most recent annual meeting was held in May. TCIM on Thursday filed proxy materials, which would precede a meeting to count the vote. Voya declined to comment. The hedge fund is hoping to send a message that Voya should commit to running a strategic review and abandon efforts to turn around its insurance business, particularly its stop-loss business, according to the letter. TCIM argued in its letter that Voya has underperformed and that the company's board has failed to hold management accountable and move quickly enough to address shareholder concerns. Voya Chief Executive Heather Lavallee, in response to an analyst's question about TCIM on an earnings call Wednesday, said, "The firm doesn't comment on rumors or headlines, nor do we allow ourselves to get distracted by it." Lavallee added, "At the end of the day, the board and management, we're always going to do what's in the best long-term interest of the shareholders. That includes restoring the stop-loss business to the target margins we have talked about." TCIM said while it believes Voya's retirement and investment management businesses are strong franchises, Voya trades at a discount to its peers in large part because it hasn't given up on its stop-loss business, which shields self-insured employers from costly employee health claims. Potential buyers for all of Voya or for its stop-loss business could include Empower, part of Great West Lifeco, Principal Financial, and Sun Life, according to a Raymond James note. TCIM, which has about $3.8 billion of assets under management, rarely gets involved in public activist fights and is known for engaging with companies behind the scenes. The hedge fund had never formally issued a public statement about one of its investments prior to Voya. Lyft's bookings climb, but growth to cool, by Kelly Clunan. Lyft's second quarter bookings rose, boosted by overall demand, particularly for its premium rides. The San Francisco rideshare company's gross bookings rose 23% to $5.5 billion in the latest quarter, above Wall Street's forecast of $5.36 billion on a higher average dollar value per ride. However, though quarterly earnings rose, they fell shy of Wall Street estimates. The company also expects gross bookings, a measure of the total dollar value of transactions on its platform, to rise at a slower clip in the current quarter, projecting growth of about 15% to 19%. For the latest quarter, Lyft pointed to growth for its premium ride offerings, a focus for the company lately. TBR Global Chauffeuring, a luxury chauffeuring company that Lyft acquired last year, saw its strongest month on record in June. Lyft's XXL offering also contributed to the strength as travelers looked for spacious options for scuba gear, luggage on European summer trips, or for large groups ready to party, the company said. The bookings growth drove second quarter revenue up 16% from a year earlier to $1.84 billion, topping analyst estimates of $1.81 billion. Rides rose 12% from a year ago to $262.4 million. Rides, with the company pointing to broad-based strength across its ride-sharing business in North America, its Free Now unit in Europe, and its bike-sharing service. Meanwhile, active riders rose 17% year-over-year to 30.5 million, marking a record. Both metrics came in above analysts' projections. Lyft stock fell 1.1% on Thursday. A tech startup raises $700 million. LumaLens makes optical gear to speed data transfer between AI servers, by Anissa Gardisi. LumaLens, a 2-year-old startup building optical interconnection technology for data centers, has raised more than $700 million at a $5.5 billion valuation as firms search for better ways to connect growing numbers of artificial intelligence chips. The financing was co-led by Atreides Management, Bain Capital Ventures, Meritech, Seligman Ventures, and Spark Capital, Lumelens said. The San Jose, California-based company has raised more than $900 million since its founding and recently began shipping equipment into the data centers of a large hyperscale cloud provider it declined to name. The agreement is valued at billions of dollars over the next several years, the company said. As companies cram more powerful graphics chips into data centers, moving information quickly between those processors is becoming a bigger challenge. Lumelens is among a group of heavily funded startups trying to solve that problem with light. The idea is to use optical connections which transmit information using light instead of electrical signals traveling over wires. Graphics processing units today are typically connected with copper wiring, which is cheap and reliable, but becomes less effective when handling larger amounts of data over longer distances. Light Matter, founded in 2017, has raised $850 million and was last valued at $4.4 billion in 2024. Celestial AI, founded in 2020, was pursuing a similar approach before Marvell acquired it in February for $3.25 billion. The prevailing challenge in the industry is the cost. Optical equipment can be several times as expensive as copper, according to Lumelens chief executive Ankur Singla, making it difficult to justify unless the performance gains are significant. Copper is way cheaper today and will be way cheaper than optics, Singla said in an interview. His goal, he said, is to close that gap. That has pushed Lumelens to focus as much on manufacturing its products as on designing the chips inside them. Singla said he's also committed to manufacturing outside of China. That stance took on greater significance this week after Reuters reported that the Trump administration is planning to ban imports of certain data center components from China, including optical gear. Optical technology has long been expected to replace copper in more parts of the data center, but the technology's high costs have slowed that shift. Optics has always been there, but never used, said Umesh Padval, managing partner at Seligman Ventures and investor in Lumelens. The AI boom could finally change that, he said. Lumelens is working on two types of optical products. One connects separate server racks across a data center, known as scale-out. The other is designed to connect chips within a single rack. The company's first product, an optical transceiver, converts electrical signals into light so data can travel over fiber optic cables. It is already shipping the small device to the company's unnamed hyperscaler, which is using the technology alongside its own AI chips. Looking at Heard on the Street, financial analysis and commentary, deal or no deal, AstraZeneca stock is a bargain. The logic of a pharma mega merger is questionable, but the drug maker's record isn't. Few big pharma bosses enjoy a stronger reputation on Wall Street than AstraZeneca's chief executive, Pascal Soriot. So the idea that he would stake his company's future on a takeover of another pharma giant left investors scratching their heads, with many running for cover in recent days. Yet the concern over reported talks might be creating an opportunity. After plunging on a Financial Times report of merger discussions with Bristol-Myers Squibb, shares of AstraZeneca recovered somewhat when Reuters reported there are no ongoing talks. Either way, AstraZeneca shares are still down over 10% for the year. They trade at less than 15 times forward earnings, well below their 18 times average over the past decade. Soriot built his reputation by doing almost the exact opposite of what he might now be contemplating. After rebuffing Pfizer's $120 billion takeover bid in 2014, he steadily transformed AstraZeneca into one of the drug industry's top growth stories. He did so by focusing on internal research and development paired with smaller deals rather than relying on unwieldy corporate consolidation. The largest was the acquisition of the rare disease company Alexion for $39 billion. Over the past decade, revenue rose to nearly $60 billion from about $25 billion, turning the company into one of the UK's most valuable corporations. But could Soriot be harboring larger global ambitions? At roughly $250 billion, AstraZeneca's market capitalization is still dwarfed by such rivals as Eli Lilly and Johnson & Johnson, sitting at around $1 trillion and $600 billion respectively. That gap helps explain why he might have considered a mega merger on a scale the industry hasn't seen in years, one that could create a $400 billion global pharma company. Investors were unimpressed by the reported talks. Mega mergers built on cost synergies and raw corporate scale have largely fallen out of favor on Wall Street. Big drug makers increasingly prefer bolting on promising biotech. Even the large transactions of the past decade, such as Pfizer's $43 billion purchase of Seagen in 2023, or Bristol-Myers Squibb's $74 billion acquisition of Celgene in 2019, involves swallowing a large biotech, not a classic merger of two pharma giants for cost efficiencies. The knock on such mega mergers is well known. They distract management, sow years of organizational chaos, and invite regulatory scrutiny. The antitrust risk would be acute in a takeover of Bristol-Myers Squibb, given the substantial overlapping portfolios both companies maintain in oncology. These deals also don't reliably deliver more innovation over the long term. Political timing might be playing a role. A more permissive regulatory climate under the Trump administration has opened a rare window of opportunity for big deals, said Jared Holtz, a healthcare strategist at Mizuho. AstraZeneca has made no secret of its push to become a more U.S.-centric company, stepping up investment in America and recently completing a direct listing on the New York Stock Exchange. AstraZeneca was already facing pressure before reports of a possible transaction surfaced. Shares tumbled early last month after the company revealed that a closely watched heart medication failed in a late-stage clinical trial. The setback raised uncomfortable questions about whether the company can hit its ambitious goal of $80 billion in annual sales by 2030. More broadly, investors are starting to question about the company's long-term growth drivers when major oncology blockbusters such as Tagrisso, Imfinzi, and Calquence lose patent protection in the 2030s. Then there was the reported target. Bristol-Myers Squibb is staring down immediate patent expirations on such core revenue drivers as the cancer blockbuster Opdivo and the blood thinner Eliquis. Wall Street naturally wants to know why one of the big pharma's top growth stories could tie itself to a company that might soon be shrinking. The deal report raised an awkward question. Does AstraZeneca have less faith in its own organic pipeline than it's been telling the market? Investor concern might be overblown. In all likelihood, the acquisition talks will go nowhere, and AstraZeneca will return to the strategy that built it, growing its own deep cancer pipeline and continuing to make more manageable deals to push into such areas such as heart and metabolic medicine. That is the reliable playbook. Even if Soriot pushes this or another large transaction over the finish line, it need not be a disaster. Despite their bad rap, many mega mergers have fared reasonably well. AbbVie's acquisition of Allergan worked out fine, with Botox and other aesthetics products helping cushion Humira's decline. Roche's purchase of Genentech was a triumph, securing control of such cancer blockbusters as Avastin and Herceptin. Soriot has built his name by resisting a mega deal once before. Reversing that stance would be a big risk, but he has earned some leeway from investors. This was by David Wayner. In money and investing, gold roars back to life. For the first time in a month, gold is shining again. The precious metal has started August on strong footing, rising more than 5% in just a handful of trading days. Gold hasn't seen gains like that since its nearly unstoppable rise at the start of the year. The war in Iran dented much of this year's early momentum as investors ditched the metal amid rising inflation expectations when oil prices surged. Gold often thrives when inflation is cooling, interest rates are lower, and the opportunity cost of holding it is minimal. When rates rise, investors tend to favor income-generating assets like bonds. Now the tide appears to be turning. Here are a few things buoying gold lately. Signs of progress in the Middle East. Iran and Oman on Wednesday were finalizing a draft agreement to open the Strait of Hormuz. Shifting interest rate expectations. Investors now see a slightly greater chance that the Fed holds rates steady in September, following its decision to keep rates unchanged last week. Investors now see a 43% chance that rates stay unchanged at its next meeting, up from 37% a week ago. Signs of a continued demand from big buyers. The crypto giant Tether added 14 tons of physical gold to its reserves in the second quarter, it said last week. Gold demand from central banks also picked up in the second quarter, the World Gold Council said, after relatively paltry levels in the first 3 months of the year. This report from Caitlin McCabe. You are listening to a reading of articles and features from the Wall Street Journal on the Niagara Frontier Radio Reading Service. The other article under Heard on the Street is Anything Goes? Not so much for CME. This is by Spencer Jacob. Are they shocked that gambling is going on in this establishment? Not really, but CME Group, the granddaddy of derivatives exchanges, would like to keep it respectable. CME provides many products needed for the normal functioning of financial markets. Its business has also gotten a big lift from the explosion in retail options trading and the public's embrace of leveraged and options income funds. The returns from those products can be iffy. The financial strength of the counterparties backing them isn't. CME offers fortress-like protection. Its recent launch of single-stock futures on 50 of the biggest U.S. companies is in part aimed at individual investors who have flocked to those other risky offerings. The futures trade 23 hours a day. They offer a simpler way to bet on stocks using leverage, much more than what's available with margin debt, but less than the most speculative options. The response from crypto exchanges and prediction markets, hold my beer. Perpetual futures, or perps, already dominate cryptocurrency trading, potentially offering leverage of 100 times. That means huge swings and the potential for a 1% move to liquidate a trader's position. The counterparties are someone else, not a mutualized exchange, and perps never expire. Not being tied to a set date means they technically aren't even futures. Now, firms offering perps want them available in the U.S. for commodities and stocks. They already are offshore. The Trump administration seems favorably inclined, but CME has been vocally opposed, citing investor safety. Perps are also a big threat to its quasi-monopolies. CME's stock futures listings have been planned for years, according to Tim McCourt, its global head of financial and over-the-counter products. It tried them before, and they fizzled. Product improvements should help them to do well this time, says Tim Quast, chief executive of market structure analysis firm Modern IR. Perps could, too, even if they're avoided by institutions who prefer dealing with more substantial counterparties. As individual speculators keep migrating to ever riskier products, the ones offering the most bang for the buck might prove the most enticing. Is that bad? It may or may not be for CME's bottom line, but there are potential ripple effects that could spook even staid investors. Leverage played a large role in a cascading crypto crash last October. It not only wiped out many traders, but also saddled crypto exchanges' insurance funds with losses when customers couldn't pay. Leverage in the U.S. stock market has been limited since the 1930s. Margin borrowing recently hit a record, but it's a far cry from levels that bankrupted many in the 1929 crash. Washington's guardrails weren't popular with the financial establishment when created, but they mostly are now. Breaking them down invites more competition. That may not be disastrous for profits. It could be for ordinary people's portfolios during a big market swoon. SoftBank borrows $10 billion on stake in OpenAI by Elliott Brown and Kosaku Narioka. Global tech investor SoftBank Group used its stake in OpenAI to borrow $10 billion from a group of banks, the company said Thursday, dialing up risk on its giant bet on the AI pioneer. The cash in turn helped SoftBank fund an even larger stake in OpenAI. SoftBank is poised to pay another $10 billion for shares in the ChatGPT maker by October, the final chunk of a $30 billion investment announced this year. The loan, announced alongside SoftBank's second quarter earnings, comes as the Japanese group embarks on a wave of hefty new AI spending commitments. SoftBank, led by billionaire chief executive Masayoshi Son, has vowed to become a leading builder of AI data centers and a major investor in AI-powered robotics. It is also setting up its own NeoCloud, a business that rents AI computing power to major tech companies and startups, similar to CoreWeave. Many of those broader AI investments rely on OpenAI. The $10 billion loan is backed by some of the biggest names on Wall Street and in Tokyo. Goldman Sachs, JP Morgan, Apollo, Mizuho Securities, and Sumitomo Mitsui all participated. Thursday's deal is an unusual move, as backers of OpenAI and other large startups typically don't invest using debt. While Wall Street banks routinely offer margin loans to investors in publicly traded companies, they are reluctant to make large loans backed by stock in private loss-making companies, given the risks inherent to startups. In a typical margin loan tied to a publicly traded stock, a borrower needs to pump more cash into the deal if the stock price falls below a certain level. Otherwise, the lender can seize the shares. OpenAI's shares aren't publicly traded, making it harder to determine how its valuation is changing. Still, SoftBank said the deal does require it to inject additional cash if its valuation falls. SoftBank also said Thursday it plans to start construction this year on the first portions of a 10-gigawatt data center campus in Ohio, a project that would be by far the world's largest AI data center cluster if completed. The Wall Street Journal reported last month that SoftBank was in talks with OpenAI about leasing the entire Ohio project, and that NVIDIA is discussing guaranteeing $250 billion of OpenAI's obligations related to the data center. Elsewhere in the U.S., SoftBank has already signed a lease with OpenAI for a data center campus of 1.2 gigawatts, a move other landlords have been reluctant to make, given the startup, by its own plans, is years away from becoming a profitable business. SoftBank's devotion to OpenAI contrasts with many other AI investing heavyweights that have decided to spread their bets, investing in several competing large language model creators. By October, SoftBank will have invested $64 billion in OpenAI, giving it a 13% stake. When SoftBank first invested in OpenAI, it was the market leader, but throughout the year, doubts have grown about the strength of OpenAI's business, as rival Anthropic has powered past it on numerous fronts, taking in more revenue and earning a higher valuation from its investors. Anthropic has also raised significantly less money. SoftBank isn't concerned. It's our choice to put all of our eggs in OpenAI as far as LLMs are concerned, rather than spread it around, SoftBank executive Mark Anya said, on Thursday, describing the San Francisco-based company as more of a partner than an investment. We are very, very confident in their model, he said. Overall, SoftBank's quarterly profit fell 18% to $2.2 billion in the 3 months ending in June, partly because of the lower gains from its technology funds business. Aiding the results was a well-timed August 2025 bet on Intel, when SoftBank bought $2 billion of shares. Intel's share price then more than quintupled as AI hype swept through the chip sector. Since June 30th, Intel stock has fallen nearly 40%. Finally, from today's paper, Apollo wins the bidding for EasyJet by Mauro Oru. Apollo Global Management has agreed to buy British budget airline EasyJet for the equivalent of roughly $7.7 billion, prevailing in a weeks-long bidding war for the carrier. The New York-based investment giant said Thursday it had followed EasyJet for years and that private ownership would give the airline the access to capital and flexibility needed to realize its full potential. EasyJet is one of Europe's best-known low-cost airlines. The business, recognized by its distinctive orange branding, controls valuable takeoff and landing slots at some of the region's busiest airports. It has also tried to leverage its brand by building a package vacation business. But the deal comes at a tricky time for the airline industry. The outbreak of war in the Middle East this year has driven jet fuel prices higher, disrupted routes, and weighed on travel demand. In April, EasyJet issued a profit warning citing higher fuel costs linked to the conflict. Nevertheless, Apollo faced competition to buy the airline. Castle Lake, an American private equity and aircraft leasing group, had agreed to a deal in principle to buy the air carrier before Apollo stepped in with a higher offer. Castle Lake said Thursday it wouldn't make a formal bid, effectively clearing the way for Apollo. Under the deal reached Thursday, Apollo is set to pay £7.15 in cash per EasyJet share, valuing the airline at about £5.7 billion, equivalent to roughly $7.68 billion. Apollo is also offering EasyJet shareholders the option of exchanging their stock for a stake in the investment vehicle that the firm is using to hold the airline. The asset manager already has exposure to the aviation industry through investments in Sun Country Airlines, Aeromexico, and Atlas Air, but buying EasyJet will give it control of one of the world's largest airlines. EasyJet was founded in 1995 by entrepreneur Stelios Hadjiioannou and has gone on to become a staple of European aviation in recent decades, as passengers sought cheaper fares compared with what many traditional carriers had been offering. The airline, which took off in November 1995 with flights from Luton to Glasgow and Edinburgh, went public on the London Stock Exchange in 2000. It now has a fleet of 300-plus aircraft, operating more than 1,000 routes across 30 countries. Hadjiioannou, whose family still controls a 15.3% stake in EasyJet, said he was satisfied with Apollo's plans for the airline and that he had agreed to support the transaction. "My family and I intend to remain invested as long-term major shareholders of EasyJet for the next chapter in the company's journey," he said. You have been listening to a reading of articles and features from the Friday, August 7th issue of the Wall Street Journal. We read from the Wall Street Journal every Monday through Thursday at 11 p.m. and Friday at 6 p.m. Your reader has been Dasha. Thank you for listening.
Coming up next in the Niagara Frontier Radio Reading Service, we have the Buffalo Criterion. At 8 o'clock, we have the New York Times. And at 9 o'clock, we have Discover Magazine. Stay with us for these readings and more. following program is intended for listeners who are blind, have low vision, or have another print disability